The name's bond, India government bond, and you're going to want to get familiar with it before the Reserve Bank of India lets retail investors like you and me buy it directly. The answers to a few questions will give you a good head start. The first question is what? What is a bond? Well, you can look at it like a loan, except think of the government as saying Thwada loan, Sadda loan, bond. When the finance minister presented her budget for the new financial year, she described the government's projected income and expenses. In this case, the government's expenses far outshoot the income, and as a result, it has to borrow to meet those expenses. The instruments that it uses to borrow are either a treasury bill, that is, if the instrument matures in less than a year, and a bond if it matures in more than a year. The interest rate that is paid on those instruments is paid through what is called a coupon. There are two ways that you can participate in the government bond market. First, the RBI, as the banker to the government, issues bonds on its behalf. Now, we'll go through how this is done another time, but just now, for the sake of this explanation, assume that you've been able to subscribe to a new issue of 10-year government bonds, each bearing a coupon of 6%. So you've got one bond worth 1,000 rupees, and that bond bears a coupon of 6%. If you hold on to that bond for the next 10 years, in each of those years, you'll get an interest payment from the government worth 60 rupees. And in the last year, along with the coupon, you'll get your 1,000 rupees back. So in a sense, that's quite similar to a fixed deposit, isn't it? The return on this investment, in this case, is 6%. It's also called the yield on the bond. Now, here's where it gets just a little complicated. Assume that after you bought the bond, the RBI decided to cut interest rates. So now the government, through the RBI, can issue fresh bonds at a lower rate to what you got. So what happens is that your bond becomes more valuable. It yields more than what the government is currently offering. And the secondary market adjusts the price of the bond you hold. And so instead of 1,000 rupees, that bond is now available in the secondary market for 1,050 rupees. Let's say I buy that bond from you. I pay you 1,050 rupees. You're happy because you pocket that 50 rupees in profit. And I'm happy because I get a bond bearing 6% for the next 10 years. But do remember that I paid 50 rupees more for that bond, so the yield for me is less than 6%. And that's the most important concept to understand if you intend to trade in the bond market. Price and yield on a bond are inversely proportional. So if the price goes up, the yield goes down, and if the price goes down, the yield goes up. So in our example, if the RBI had decided to raise interest rates instead of cutting them, your bond would be worth less. So if you were to go out and sell that bond in the market, you would get less than 1,000 rupees, or in other words, you would have to sell it at a loss. And that essentially is how a bond works. Do watch this space for more though. We'll soon tell you about the tax implications of investing in bonds. This is ET Now.